Okay, so good evening. So we'll be starting today's class. I think all your doubts are clarified. So as in the last class we have covered two theories. Can you recall what are the dividend theories or the dividend policy theories you have covered in the previous classes?
Walter's model and Gordon model.
Walter's model and Gordon's models are you have covered, and we have grouped these two theories into one category. Can you name them?
Dividend relevant
Dividend relevant theory. Okay,
relevant theory.
dividend relevant. And we are supposed to learn one more theory that is called as the dividend irrelevant theory. That means in that theory, we have to understand that dividend or that theory, the founders of that theory says that the dividend is irrelevant. Irrelevant in the sense dividend or declaration of dividend doesn't affect the market price of the shares. Okay,
Yes, sir.
so that theory is called as. Can you tell me the name?
Irrelevant. MM approach theory.
MM theory or MM approach or MM model you can call it. So I am going to share with you this relevant screen for that. Just wait a minute. I think you are able to see the screen.
Yes, sir.
Okay, this is dividend irrelevant theories we have to talk. And this theory is Modigliani and Millar's theory. As you can see, are you able to see these photos?
Yes, sir.
Okay, they are the founders of this theory, Mr. Franco Modigliani and Martin H. Miller. Both of them, as you can see, they are the Nobel laureates. They have developed this particular theory. This theory is called as the Modigliani and Millar's theory, and popularly it is called as the M and M theory. Okay, or MM theory also. We'll understand what is
Yes,
that
sir.
theory. And these people have developed this theory, and they have said that dividends are irrelevant. Dividend doesn't matter. Dividend is not going to affect the share price. Consequently, dividend is not going to affect the value of the firm. Their point is that investors are indifferent to dividends and the capital gains.
Yes, sir.
Capital gains means the price appreciation. They are also indifferent. So dividends has no effect on the wealth of the shareholders. Dividend cannot change the share price. They say that the value of the farm is determined not by dividend but by the earning power of the farm and also by its investment policy. What is the plan of the farm to make investment? That affects the share price and also the earning capacity of the farm. That also affects the share price.
Yes.
Okay. What is earning? Earning, you can say
Yes.
the total available profit of the farm. That's the earning. Okay. Right. We are talking about what will happen if out of this available profit, if you distribute something as dividend and retain something as our retained earning. Right. That means we are trying to say that available earning, how that is going to be distributed, how it is going to be divided into two parts. One is payout, other part is
Yes,
retention.
sir.
And Modigliani and Miller, both of them say the manner in which the earnings are divided into dividends and retained earning doesn't affect the value. Value is not going to affected by this thing. How you are dividing that earning. Value will be affected by the total earning, but not the way you divide it. That thing, the division or the ratio of these two things is not going to affect the value of the thing. Or some people also say that suppose there is a cake, you cut it into two pieces, or you sell it as a whole, that is not going to affect the price. That means price of a cake is not going to be affected the way you cut it into pieces. Right.
Yes, sir.
So just like that, earning we are cutting into two pieces. One is retention, one is payout. And we cannot say the way we cut it into two pieces, whether 60-40 or 80-20 or 50-50, that is not going to affect the share price. But ultimate earning is relevant. Dividends is irrelevant. Okay. That is the theory says. Right. So declaration of the dividend will not affect the market price. As per this approach, share prices are affected by the earnings, but not how the earnings are split between dividend and retained earnings. Right. And they also say That definitely declaration of the dividend has got a positive impact on the market. It shows a positive sign that the company is doing well, company is surviving, company is doing good business. If the dividend is declared, it will send a
Yes, sir.
positive signal to the market. But that doesn't mean that merely by declaration of the dividend, the market price can be changed or market price can be improved. That is not possible. Market price is not going to affect it by just by declaration of it. Right. And
Yes, sir.
Mr. Modigliani and Miller has taken some assumptions. Please read out these assumptions one by one.
All equity firm.
All equity farm. That means there is no debt. Entire money has to be financed through equity. Yeah. Second point.
The company makes a fixed investment at the end of each year.
Okay. Here you see this is a another assumption. We have to see this assumption. This is again one of the one among very relevant assumptions. And by using these assumptions, the founders of the theory have proved that dividend is irrelevant. Here the assumption is that company needs a fixed investment. Every year company wants to make some investment. That means there is a requirement of money. A fixed amount of money is required every year. Right? So that we have to take it as an assumption. Now, next point.
Investment is financed either through retained earning or through fresh equity.
So when money is required, okay, we don't have any debt, it is an all equity farm, is it done? So and every year you need
Yes, sir.
investment.
Yes, sir.
So how we can finance that investment? Investments can be financed either through retained earning, that means either through our reserves or through fresh equity. Either I can issue new equity
Yes,
shares
sir.
or I can use my retained money. Right. So that is
Yes,
the
sir.
assumption. Then point
Yes,
number
sir.
four.
There is no flotation cost.
You know what is flotation cost? Can you tell me what is that?
Yes, sir.
Flotation cost.
The extra cost which is required for during the issue of securities.
Exactly. When securities are issued, we have to spend some money for floating that security. And here the concept is that there is no flotation cost. Flotation cost is not there. Okay. Without that means without spending any money, we can issue securities. Right. Now point number five.
Yes, sir. Perfect market environment.
Yeah.
First one is large number of buyer and sellers.
Yes. Next.
Second one is all buyers are equally well informed.
Yeah.
Third one is uniform price across all markets.
Mhm.
Fourth one is no transaction cost.
So we have understood when you have studied economics, you have understood what is the meaning of perfect market. And Modigliani and Miller's theory also assumes that thing that the market is perfect. When I say market is perfect, that means there is a large number of buyers and sellers. So many people are there to sell the product, and so many people are there to buy the product. And all buyers are equally well informed. Information flow is there. Good, there is good information flow. Everybody knows the thing. Uniform price across all markets. When it is a perfect market, price is uniform. And there is no transaction cost. That means to buy or sell something. Okay, then we don't have to incur any transaction cost. Understood? So these are the assumptions
Yes,
Yes, sir.
the founders of the theory has taken, so that theory their concept can be proved. Okay. Now to prove that thing, how we'll be able to understand this theory? It may appear to be little complex, but you can find it is a very easy theory. You will be definitely able to understand it. So we'll try to understand it with the help of this particular example. Okay. First, you see what is the first column?
yes, sir.
We'll see how model works. Right. Let us say what is the first column?
Yes, sir. Profit
Profit. So we are taking three situations, and everywhere you see what is the profit amount.
100.
So in all the three situations, you see profit is 100, 100, 100. So we are assuming in three situations profit is 100 everywhere. Okay. What's the second column?
Investment required.
So in theory, we have assumed that every year we need a fixed investment. Okay. A fixed amount of money is required
Yes, sir.
to make an investment. And here in this particular example of this particular illustration, I have taken that the fixed amount required is 160. It's an assumption only. Let us say every year company needs 160. Okay,
Yes, sir.
understood. So this is an assumption. Profit is the fact, and this is an assumption. Now we'll see the first case. We'll see this row only now. Let us assume the farm is declaring 70 rupees as dividend. Third column is dividend.
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 Okay, you tell me what
Yes,
is
sir.
the profit of the farm?
100.
100. Okay, both of you are agreeing
Yes.
100.
Yes.
Yes, sir.
Dividend is 70. Then what is the retained earning?
30.
30.
30. So when dividend is 70, retained earning is 30. That means farm is paying 70
Yes,
and
sir.
retaining how much?
30.
30.
30. So 30 is there in this company's retention. Tell me how much money company needs for investment?
130.
The, totally. What is the investment required?
Tot 160.
160 is required. And how much company is having?
Yes, sir.
How much company have?
30 only.
Okay,
30.
160 is required, and company has retained 30. So additional, what is the additional money is required?
130.
130 is required additional. All of you are sure? And 130 is required,
Yes, sir.
and company
Yes,
cannot
sir.
take debt because it's an all equity form. So what the company can do? Company can issue fresh equity,
Yes,
right? There is no
yes, sir.
retention money. Company can issue new equity, fresh equity. Okay, for how much? 130
Okay.
rupees. So company has issued fresh equity for 130. Okay, meaning the equity shareholders will pay 130.
Yes, sir.
Yes, sir.
Okay, and how much we are paying to the equity shareholders? हम लोग कितनी दिए हैं इस साल equity shareholder को?
70.
70, because that is the dividend. कि हम लोग तो we have given
Yes, sir.
70 as dividend. Okay, company has given 70 as dividend, and company has collected 130 from the fresh equity. So if you net up this thing, that this much we have received, this much we have paid. So net effect is that we are collecting 60 rupees from the shareholders, because 130 minus
सर
70.
सर ये फ्रेश इश्यू तो न्यू शेयर होल्डर के लिए है ना,
Yeah.
डिविडेंड
Now,
तो
what's
फॉर
their
एग्जिस्टिंग
news
शेयर
here?
होल्डर.
Try to understand. We are not talking about the dividend part right now. New and old taken together, they are the shareholders of the company. Total we have collected. Let us say from the all the shareholders in this year, we have collected 130. Okay, and to our shareholders we have paid 70. We are not creating a distinction
यस
between new and old. From the shareholders, 130 is collected, and to the shareholders, 70 is given. Okay. Now the
यस
net payment is 60. Are you understanding?
यस सर.
Yes, sir.
Okay. Do you have any query? Now don't distinct between new shareholders and old shareholder, and do not think that the dividends are given to the old shareholders and fresh equity is collected for new shareholders. But the fact is that that is equity. From equity through equity source, 130 is collected, and towards equity 70 rupees is paid. So net
यस
is
सर.
170. Okay, we have to think it like this,
यस सर.
right? Okay, so
यस सर.
60 rupees is net cash flow is 60 rupees. Net cash inflow is 60 rupees. 130 is inflow, 70 is outflow, net inflow is 60. Okay, now we'll say the second situation. Second situation also profit is 100. Investment required is
यस
160. Let us say I am declaring
यस सर.
dividend 30.
Yes, sir.
Okay, if I have declared dividend 30, then how much is my retained earning?
70.
70. Okay, I need 160, but money available is 70. How much should be the fresh equity?
90 rupees.
90. Sure, are you understanding?
Yes,
यस
sir.
सर.
So 90 I am collecting, 30 I am giving as dividend. So effectively, how much I am collecting? 90,
60
30 if
rupees.
I net it off,
60.
60.
60. Okay, second situation is 60. Now we'll see the third situation. Again, profit is 100. Again, investment required is 160. Let us assume we are paying dividend
Ye-
50. So how much is the retained earning?
50.
50.
50. How much fresh equity is required? Since I need 160, but I have 50. So how much I need fresh equity?
110.
110 is required, right? And 110 I have collected.
Yes,
And
sir.
how much I have paid? 50. So net effect is
50.
how
Yes,
much I
sir.
have collected? 60.
60.
Okay. Now in this particular example, we have seen three kinds of dividend payments. One case you can say 70, I can say it is a high dividend. Another case I can say 30, it is a low dividend. Another case you can say 50, you can say the moderate dividend we are paying.
Yes, sir.
Okay.
Yes, sir.
Out of the 100, I'm 70 means it is a high dividend. Out of 100, 30 means I have low dividend. Out of 100 profit, I'm paying 50 means moderate dividend. But now you have understood that whether I
Yes,
pay
sir.
high dividend or low dividend or moderate dividend, effectively the money I'm collecting from the shareholders in all the three situations are same. Is it not?
Yes, sir.
Effectively,
Yes, sir.
effectively, I'm collecting the same amount from the investor, provided I have a need to invest. If investment is required, effectively, in all the three situations, I'm collecting same amount, 60, 60, 60. Okay. Meaning, declaration of
Yes,
the
sir.
any amount of dividend resulted in the net payment by the shareholders is always same. Net payment by the shareholders is always same, irrespective of the dividend policy adopted by the company. Okay,
Yes, sir.
this happens because one thing is that fixed, we have assumed that there is fixed investment, and we have also assumed that there is no debt, only we have to manage through equity, right? Only equity is there. So when only equity is there, we have to see how much money is collected from the equity holders and how much money is paid to the equity holders. Right? All equity shareholders, new and old, are same. Effectively, we have to say this much money is collected and this much money is paid. So effectively, net collection is this much. Understood? So
Yes, sir.
this
Yes, sir.
this illustration shows that irrespective of your dividend payment, net cash flow is same. If the shareholder can understand, price will not be impacted. Share price will not be impacted because shareholders will understand, okay, even if company is paying high dividend or low dividend, whatever might be, the investment is required and company has to collect money through equity shareholders. Effectively, the money which is collected from the equity market is same. Okay, that is one way of understanding the
Yes,
theory.
Yes,
sir.
sir.
Another way of understanding the theory is that very simple way we can say, this theory assumes the market is perfect, is it not? And try to understand in the
Yes,
perfect
sir.
market, R is always equal to K. Okay. When R is
Yes,
always equal to K, any kind of dividend will not affect the share
yes,
price.
sir.
Is it not? So therefore,
Yes,
dividend
sir.
is irrelevant. The moment we are saying R is equal to K, that is market is perfect. Okay. When the market is perfect, then any dividend declaration doesn't affect the market price. Because any amount of dividend,
Yes,
other theories also says the same thing, that any amount of dividend you declare, it is not going to affect the share price provided R is equal to K. A return will be equal
yes,
to
sir.
cost if the market is really perfect. Okay. Okay.
Yes, sir.
Now, having
Yes,
understood this, I think broadly we have understood what is theory or Modigliani and Miller's model. So now what we are going to do, we are trying to understand some of the equations which are developed by Modigliani and Miller. Okay. Now let us try to understand the equation from the very beginning. I think you are familiar with this formula. This is the formula which I am showing you right now. Are you familiar with this formula?
Yes, sir.
What it says?
Yes, sir.
P0 is equal to,
P present value of future dividend and future price.
yes. So we know that today's price is always the present always the reflection of dividend as well as uh, future price.
Price
Okay,
up.
and that needs to be
Yes, sir.
discounted at cost of capital so that we can arrive at the present value. As you said rightly, that the
Yes,
today's price is the present value of is the sum of present value of dividend, expected dividend, and the present value of price. Okay,
yes,
so
sir.
this theory also assumes at the beginning of any period, when you start a particular investment period, price is determined like this: present value of the dividend as well as the present value of the market price. Okay,
Yes, sir.
and you know what is the meaning of
Yes,
P? P is the market price, R is the capitalization rate, D1 is the
yes, sir.
expected dividend at time 1, and P1 is the
Yes, sir.
expected market price at the end
Uh,
of time 1. So
at
on
time.
that basis, this is how we
Yes,
can arrive at the price. Okay, that means
yes,
suppose you are investing today 100 and you are expecting that in future you will be getting dividend of 5 rupees and the price will become 105. That means the 100 rupees is the present value of 5 plus 105.
yes, sir.
Is it? 5 plus 105. Present value of D1 plus P1. D1 is 5, P1 is 105. And if you discount it at a particular factor, at a particular rate of interest, a particular cost, it should become 100. Right? Okay. And also we know that if the farm is committed for equity financing, that means if there is no debt, then how the farm can arrange money? Only through retained earning or fresh equity.
Yes,
Is it not?
equity, sir. Yes,
And
sir.
retained earning, when a farm earns, then there is two options. Either it has to retain a part of it or it has to distribute
To declare dividend.
dividend.
Yes,
So earning can be divided into two parts only. Either one is retention, other part is declaration of the dividend. Okay. And
yes, sir.
this model says that the discounted value per share before and after dividend payment will be the same. That means before dividend payment and after dividend payment, right? So discounted value per share will be same, and that is how they try to prove that the dividend is not going to impact the share price. Discounted value will be same. How he has developed that theory? The model, this particular formula, involves several steps. It has been derived through
Sir,
several
here
steps.
discount value means R.
Discount value means present value.
That indicating R.
That indicating R. R or KE. Here we are taking R. If KE is known, it can be KE. In a perfect market, R is equal to KE.
Yes, sir.
Okay. Now what I'm showing how
Yes,
this formula has been developed. You can refer to any textbooks or your study material. You can find the formula looks little complex. It has been derived through various steps. We will not in detail go through these steps. Later on, you can see these steps. You can understand how exactly the formula has been derived. I am explaining you in short, but will not spend much time on derivation part of it. So you agreed that P0 is equal to D1 plus P1 divided by 1 plus K. Okay,
yes, sir.
that you are agreeing, right?
Yes, sir.
So here what happened, next time what happened, next derivation what we are doing, we are multiplying throughout n. N means number of shares. So it is, let us say for one
Yes,
share, this is the formula. So suppose 10
yes,
shares,
sir.
we have to multiply. So both the
In,
sides, in all the factors, I am multiplying here n, here also n. And the formula
yes,
looks like that. And again
yes,
multiplying
sir.
n with d1, n with p2, a formula looks like this.
Yes, sir.
Okay. Okay. Now what I am doing,
Yes, sir.
what I am doing, adding and subtracting mp1. Now you might thinking what is mp1? M is, you assume M is the new shares that is going to be issued, fresh equity, number of new shares, and P is the price. Okay. So what I am doing now, I am, you see, adding mp1, then again deducting mp1. The same thing, adding plus deducting.
Yes, sir.
Now formula will be evolved like this.
Yes, yes, sir.
Okay. But the MP1, which is the total issue of new shares, okay, in time period 1 is equal to the investment in time period 1 less the retained earning. So what happens? The firm is assumed that it is making some investment, and investments are made out of its earning. Okay, out of its
सर
earning.
सर ये
Yeah, tell me.
सर थर्ड थर्ड स्टेप में जो हुआ है
Hmm.
उसमें P1 कॉमन लाने के बाद फिर P के साथ N कैसे आया? वो तो अंदर है ना, P कॉमन लेने के बाद N प्लस M होगा। तो
Which step
ये जो
you're
एक्स्ट्रा
talking
N,
about? You're talking about this portion.
ये सर इससे
Uh,
P1
you
कॉमन
see,
हो
you
गया।
see, you see. This part and this part is same. Only thing is that
ये सर,
MP1 minus MP1 is added,
ये सर
MP1 is deducted.
मैं नेक्स्ट स्टेप पूछ रही हूँ।
Next step is what is happening here? NP1
P1 कॉमन,
plus NP1.
ये सर,
Okay,
ये सर।
okay.
सर मैं पूछ
Then
रही
what
हूँ कि
happens?
यहाँ पे तो P1
Uh,
P1
uh,
कॉमन लेने के बाद तो N प्लस M मतलब
so your point
होगा।
is okay. You
तो
say here it should be only instead of MP1. You are right.
P1
It should be P1. That's right. That's right. It's a printing error kind of thing. Okay, it's P1. Okay, that means new
सर
share
वो
plus
नहीं,
old.
ये वाला,
Uh, which one?
ये जो NP1 है, NP1 मल्टीप्लाई इंटू N प्लस M, मैं बोल रही
MP.
हूँ कि ये सिर्फ P1 N प्लस N होगा।
Yes, yes, right, right. So that is that. Okay, so that should be P1. If you are taking P1 as common and P1 common. Okay, then there's two other things are added in that particular equation. One is what is the retained, what is the earning where I am calling it as the X, and investment I am calling it as uh, I at the investment at a particular point of time. So by doing this, I am arriving at a final formula is like this. That is n plus m into p1. Okay. Now here I will explain you the final formula. N means what? New share. M means what? Old share. Sorry. N means old share. M means new share. Are you getting?
यस सर, यस
So
सर,
total number of shares into P1. Total number of shares into P1. So this is the total equity
यस सर,
price minus investments are required. So whatever investment is required, that cash flow will be going out. So minus I1 plus X1. X1 during the year, this much earnings will be there. So this is the, you can say this is at the beginning, this is the value minus investment plus earnings. Okay. This is, you can say, the total cash flow which has to be discounted at 1 plus KE. Right. If I'm discounting, I'll be getting the value of new shares. Or I can say the new shares value is the new shares number into P0, which will be equal to old shares plus new shares into price one into price minus investment plus earning
यस
discounted with cost of capital.
यस सर,
Okay. So this formula, this is how he has derived, or Modiglian and Millers have derived, that NP0 is equal to, that means all value of the new shares is equal to M plus N old shares plus new shares into their price minus investment required plus earnings made. Okay. And they explain
यस सर,
in this particular equation, are you finding dividend anywhere? We started with
नो
dividend,
सर,
but now whether dividend is there.
नो सर,
So they say dividend is irrelevant.
यस सर,
Since you see the finally when the price is arrived at, dividend is not coming into the picture. Dividend is irrelevant. Okay. The same formula
यस
in some other textbooks has been explained like this. NPO is equal to N plus delta N. Delta N means new shares, N means old shares. Into price minus investment plus Y is called as the earning divided by 1 plus K. So if you see a study material,
Yes, sir.
that this formula is given. Okay. Here also you see
Yes,
there
sir.
is no dividend. Therefore, dividend is irrelevant. This is how they have explained.
सर स्टेप 4 थोड़ा और एक बार समझा सकते हैं सो ये वाला स्टेप 4
Able step 4. Okay. You see what this
यस सर
particular step 4 says. Okay. That is, you see, what is n?
n is the old share
Old
New
share.
number of
n is the old share.
yes sir
Okay. So
Yes, sir.
number of old shares into dividend paid per share. Okay. Plus number of old shares into price, their price, multiplied with,
Yes, sir.
okay, old shares plus new shares minus, whole minus, this will be, this part will be talking about the total value of the shares, total value, minus, out of that cash flow value, investments will be deducted,
सर
plus,
ये
and
कहाँ से आया
no, this is,
ये
you
तो
see, we are
प्रीवियस
making
में
an assumption.
MP
No,
1
we are
थे
making an assumption that every year we have to make an investment. So in year one, I have to make an
यस
investment. Therefore, in year one, I am deducting I1.
यस सर
Okay, ठीक है,
Yes, sir.
ठीक है. So you see, this is an assumption. Assumption has to be made like this. Okay, I think straight way I will be explaining you the final formula. What is happening? This is, are you getting? This is the total value. New shares plus old shares into price. Out of that price,
यस सर
investment will be, out of that value, investment made will be deducted, plus earnings will be added,
यस सर
and finally this will remain the cash flow, ultimate cash flow, and the cash flow will be discounted.
यस
Okay, you check it, go through this formula once again, go through all these derivations, and still you are having some doubt, then I will be explaining you. Okay,
Yes, sir.
यस सर
right. So now again, finally coming to this figure, that this is the ultimate formula that we have derived at, and on the basis of this formula, Modigliani and Miller says that dividend is not relevant. Okay, payment of dividend doesn't affect the share price, because in ultimately the share price, when we arrive at the formula, dividend is not coming into the picture.
यस
Okay, well,
यस सर
lastly, one more theory we need to cover, that is, this is in fact a new addition. I told you there are only 3 theories in the study material, but your new study material, which has been revised, includes one more theory. And you know, when I had shown you first the chart, several theories I had shown you.
Yes.
Okay, let me show you. Yeah, you see, these are various kinds of theories. Okay, traditional theory, dividend capitalist theory, model, residual theory is there, Solomon's theory is there, one more Lintel's theory is also there. So, we are broadly focusing on these 3 models. I told you 1, 2, 3, but since there is one, this fourth model has already been added, so we quickly will be covering that aspect also. That's also a very simple theory. We can understand it very quickly. Just a minute, let me go to that particular slide and explain you that. Okay, this is residual theory of the dividends. Yeah, according to this theory, what happens? Dividend is a residual decision. It's not a main decision. You can say uh, it is one of the residual decision. Why it is called as the residual decision? We have to understand the concept behind this. This particular theory assumes that if the firm has retained earning, and farm has got some investment opportunities. Investment opportunities means acceptable investment opportunities, right? You know how to evaluate the investment opportunity. We know in the capital budgeting chapter we can apply the capital budgeting techniques like IRR, NPV, etc. You can decide which are the acceptable projects. So if the farm is having retained earning and farm is having acceptable project, then what the farm should do? The earnings should not be ideally till that time when acceptable projects are there. The earnings should not be distributed to the shareholders. But when acceptable projects are not there, then dividends should be distributed. Are you getting?
Yes, sir.
So
Yes, sir.
if the farm has retained earnings left after financing all acceptable investment opportunity. So there is an acceptable investment opportunity. Till that time, we should not pay any dividend. But once that is over, and still there is some retained earning which is left out, then as a residual decision, we have to pay dividend. A dividend should be paid. So if no fund is left, no dividend. Therefore, now dividend policy becomes as a kind of financing decision. That means we are financing the project, and only after that, if some money is left out, we are declaring dividend. So therefore, in this kind of situation, it's a passive decision or a residual decision. Okay. Since it is a kind of residual decision, that itself implies that dividends are irrelevant and shareholders are indifferent between the dividends and the retention. Shareholders are not bothered by the how much dividend is paid and how much is retained. If
Sir, which project is acceptable and which project is not acceptable?
yeah,
How can we determine that?
you can determine by applying your capital budgeting techniques. Capital budgeting chapter we have studied various kinds of
Okay,
capital
sir.
budgeting techniques.
Yes, sir.
Is it
NPV and IRM method.
yeah, NPV, IRR, payback method, all of
Yes, sir.
these are discounted cash flow method. So many things you have learned, is it not? Profitability index, all these methods we have learned. So by applying all these things, we will be able to decide whether it is acceptable or not acceptable. Acceptable projects is
Yes,
there, then dividends should not be declared. But acceptable
yes,
projects are exhausted, then dividend can be paid as a residual disease.
yes, sir.
Right. So if available investments are plenty, then the percentage of dividend will be zero. So many acceptable projects are there. They don't pay any dividend. You have to use the retained earning for this
Yes,
acceptable.
sir.
If the farm is
Yes, sir.
unable to find any profitable investment, then payout ratio should be 1. 1 means 100%. Right? Ratio should be
Yes,
1.
sir.
Okay.
Yes, sir.
That
Yes,
means
sir.
100% should be paid. Okay. So that theory particular you can explain, you can understand with the help of a particular this particular picture you see. Uh, First of all, you see here this particular you see blue color line you can see that is what is marked as IOS. IOS means investment opportunity, right? A farm has got some investment
Yes, sir.
opportunity. Let us say initially up to this farm can invest at 10%. Okay, and if let us say up to this,
Yes, sir.
let us say up to this farm can invest at let us say 18%. If you want to more money, if you more you can invest more, then investment or the return will be reduced. Return will become 16%. And if you further
Yes, sir.
make investment, the return will be reduced, let us say 12%. If you still go further, keep on investing, then return will be maybe coming down to 10%. So as you keep on more, as you
Yes.
keep on investing more and more money, your earning capability will reduce.
सर रिड्यूस कैसे हो सकता है इंक्रीज होना चाहिए
You see, farm has a capacity to make investment. That means up to that point, farm can use that money profitably. Beyond that, it cannot use it profitably. Right? Let us say, okay, let us say you are doing a kind of business. Let us say you tell me what should be the profit of your business. क्या business आप करेंगे मेरे को बताओ. एक example दो. What business you would like to do? Give me an example.
Textile.
Textile. Okay, what kind of business you will do? Is it a textile shop, textile factory, textile dealership? क्या करेंगे आप?
It is a textile shop.
It's a textile shop. आप बताओ कितनी आपका इन्वेस्टमेंट लगेगा उसमें?
10 to 20 lakh.
10 to 20 lakh. Suppose I can give you 10 to 20 lakh. Suppose I will give you. So what will be your profit percentage? कितनी 10 20 लाख आपको दे दिया, प्रॉफिट परसेंटेज आपका प्रॉफिट परसेंटेज कितनी होगा?
12%.
कितनी?
10%.
15?
10%.
10%. So
10, 10.
you feel you are capable of, if I give you 20 lakh, you are capable of earning at 10%. ठीक है?
Yes, sir.
ठीक है?
Yes, sir.
Suppose मैं आपको 20 से 25 भी दे दूंगा, still you may be able to keep it at 10%. You can able to make profit at 10%. 25 लाख भी दिया, आप 10% कर लो. ठीक है? चलो मैं आपको 25 लाख नहीं 1 करोड़ दे दिया. आप अभी इमीडिएटली सोचोगे मेरा रिक्वायरमेंट, योर रिक्वायरमेंट इज एट 25 lakh, but I am giving you 1 crore excess money. So what you will do?
Yes, sir.
You will think, okay, 25 I need, remaining 75, let it put it in the bank for the timing, because you don't have any opportunity to invest it in a profitable way. So what you will be doing? You are parking it in a bank. So bank will give you 7.5%. आपका return, whether return is reducing or not.
सर अगर बैंक में ना रख के डायरेक्ट फी से कोई
बैंक
दूसरा
direct
वाला
से
टेक्सटाइल शॉप
क्या करोगे? क्या करोगे? क्या करोगे बताओ? What you are
और
planning
एक
to do?
टेक्सटाइल शॉप
हाँ. If you or you
तो
or
ज्यादा
if
रिटर्न
if
है.
you multiply also, then there is a limit. That also you can earn more, but again up to a particular limit. After that you will find beyond that. If still you are having excess money, you are saying that you can earn more. You can more means that is another profitable project. But if the profitable project is existed, all profitable projects are existed, then you don't have opportunity, is it not? Then naturally your earning will
Yes,
fall. So if you are
yes, sir.
finding out that you will open another textile shop, then good. Then you are having one more project which is profitable. But that is exhausted. Then what we will do? One more. That is exhausted. Then we will be enter into some other business. That's also exhausted. Then finally what you will do? Now you will find that profit is getting reduced. What will happen? Your earning is getting reduced because your earning power got adjusted.
Yes, sir.
Understood it, now? So that is
Yes,
the
sir.
point. That is the point for which we are saying that beyond a particular point, your investment opportunity schedule will give you relatively lesser and lesser rate. Investment
Yes,
opportunity
sir.
schedule will always reduce. You can earn more so long as you need it. But if money is there beyond that, then you will be your return percentage will be reduced. Okay. Now this is the behavior of our return. And if you see our cost you see up to a particular amount, cost will be like this. After that, if you want further money, cost will increase. Suppose you want a loan of, let us say, 20 lakh, you may get it, let us say, at 9%. But if you want 30 lakh, you might have to pay more. You want 50 lakh, you might have to pay more. Is it not? So cost of capital will increase. If you want more and more capital, cost will increase. So one side your return is falling as a result of additional investment. On the other side, your cost is increasing as a result of additional capital. Okay. Now here this point says that so long as this blue line is above the red line, blue line is above red line means you have opportunity to earn more. Then don't pay dividend. But after this point, start paying dividend. No need to keep retention money. Are you understanding?
Yes, sir.
Understanding
Yes,
this
sir.
particular theory?
Yes, sir.
Okay, so this is about residual dividend theory. Right. With this, we have covered all the theories which are there in our syllabus. Just a minute. right? All the theories which are there in our syllabus, we have finished. If we have some query, just, yeah, then you may feel free to ask that thing. And I understand that in that theory formula portion, some query will arise and it should arise also. But I request you that go through that derivation once again at home, minutely try to understand, ignore if there is some printing mistake and all, but you'll be able to understand that formula. Still you are not understanding, then we'll be repeating this. Okay.
Okay, sir. Yes,
Okay.
sir.
Any other query you have right now?
No, sir.
Okay. So I'll be informing you when will be our next class. Then what is the chapter we should cover in your next class? We have to start a new chapter then. Which chapter?
Working capital.
Working capital. Okay. So working capital will be covering.
Yes, sir.
Right. So working capital, after that,
Yes, sir.
any other chapter? What are the other chapters which are left out after working capital?
Another one is portfolio management.
Portfolio management. Then
और एक सिक्योरिटी एनालिसिस है, उसमें बहुत थ्योरी है,
okay. So with that,
प्रॉब्लम
our
नहीं है.
course will be finished. That means three chapters. One is working capital. One is you said portfolio management. One is
portfolio management,
security analysis.
security analysis.
Right. With that, we will be able to complete our syllabus. Right. So I'll be informing you when we will be
Yes,
conducting
sir.
our next class. Thank you very much. See you at our next class.
Yes, sir. Yes, sir. Thank you, sir. Thank you,
Thank you,
sir.
sir.